Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
One of the topics I've been really fascinated, we can probably go off in different directions as we talk about this in more detail, is fundamentally about capital allocation and equity issuance and retirement. Let me first say that one of the most powerful signals we have in markets, and I'm telling you something you already know, is companies issuing and retiring equity. And it's not really a symmetrical signal. When companies issue equity, it tends to be worse for subsequent total shareholder returns. And when they buy it back, on average, it tends to be a somewhat positive thing. But basically, that's a really powerful signal. The second issue is capital allocation. So if you're an executive company, the idea is to buy low and sell high. And that means if your stock is undervalued, you buy it. If it's overvalued, you issue it. And so what we are interested in is taking a look at the sweep of companies. Obviously, lots of issue stock for compensation. That's fine. Lots of companies buy back stock. Typically speaking, smaller companies are the ones that issue equity. That makes a lot of sense, right? They're getting going. They preserve cash. It's all good. And typically older companies, more cash rich, more profitable, they buy back stock. But there's this interesting group of companies sort of in the middle that both simultaneously issue a ton of equity, mostly for stock-based comp, and also buy back a lot of stock. So the question we're asking is, if the stock is mispriced, and management probably has a better look at that than investors, since they have better information, one side of that trade's got to be suboptimal, right? Now, I'm not sure in the big wash of total shareholder returns, it makes that big a difference, right? I'm not sure. There are a lot of other factors that determine total shareholder returns. But it's just sort of this interesting intellectual thing. And I don't know if it's really cognitive dissonance. I think managers do think about both of these things, but not necessarily in the exact same breath. They do think about buybacks in the context of stock-based comp, but less stock-based comp in the context of buyback. So that's just sort of an interesting topic just to throw out there. It's just an interesting corporate finance topic, interesting capital allocation topic.
It feels like if I put myself in the mind of one of these executives, on the one hand, they're like, hey, we really want to reward employees, although I imagine most of this is going to the C-suite. I'll default to you on this. But in their head, they're like, we also don't want to dilute shareholders. So we're just going to buy this back to mop up this stock-based compensation. Do you think that's kind of what they're thinking?
I think different companies have different philosophies on this. And it's actually been determined because John Graham and others have done surveys of CFOs and executives, and they ask them this direct question. And almost always the answer, yeah, we buy it back because we think it's undervalued. It's a good signal to markets and so forth. But they very quickly will tack on, like, we want to offset dilution from stock-based compensation. We want to enhance our earnings per share, and if that could be a possible case. Right. You're also raising another issue, which is what is the power of stock-based compensation? And to the degree to which it aligns the interests of shareholders and executives, that's great, right? Obviously, as a mechanism to retain employees that you want to retain, that can be very valuable. But, one of the questions is whether what happens is if your stock goes down, do companies just let their employees suffer along with the shareholders, or do they issue more equity to sort of fill the gap? Is it a pay delivery system, or is it really incentive compensation? And 2022 was really an instructive thing. The stock market went down high teens, 18 or 19%. Stock-based compensation for the Russell 3000 companies went up 19%. So it wasn't like the employees were not taken care of. They just bumped up the comp in order to sort of backfill what they lost in foregone, basically stock-based comp. So then that becomes the issue. We're all on board if management gets a lot of equity and they deliver a lot of returns and they do really well. We're all on board with that. The issue becomes if they're middling, are they using this a way to deliver pay versus to incentivize?
We talk a lot about this on the podcast, and no one talks about it more than really you or Buffett. I think Cliff really drills into buybacks and all the misinformation surrounding the topic, which, and Professor Damodaran does as well, but kind of all the misinformation around buybacks. But to me, the big part of this cycle has been this share issuance topic. So a lot of particularly tech companies out in my home state issuing a ton of share issuance. Brad Gerstner, will throw these in the show note links, talks about some of these companies that are just massive amounts of stock-based compensation. I think Snapchat would certainly be one that fits the bill. When you look at this cycle, so the past 50 years, buybacks have been ascendant, of course, and everyone I think kind of gets that or starting to get it. The share issuance part, I feel like, is a more recent entering the discussion, because I think we usually, when we do screens, it's like the average stock roughly, I think, is in the stock market's a share issuer. And you have all these companies that are issuing shares, but that tends to be something that people ignore. How do you think about this whole discussion of time varying buybacks as something that influences returns?
In this century, so since the year 2000, so let's call it almost 25 years, by our numbers, aggregate equity issuance, and equity issuance would not just be stock-based compensation. Actually, the biggest piece of that would be stock issued for M&A. But stock issued for M&A, seasoned equity offerings, which are offerings that are not related to IPOs, and then stock-based comp, which is the second biggest piece. That's been around a little under 10 trillion. Share buybacks, also last 25 years or so, have been about 14 trillion. So retirement exceeded issuance by about $4 trillion in the last quarter century, roughly speaking. Now, a couple of things I'll just mention. Buybacks, as you point out correctly, in the United States sort of ascended starting in 1982. People have to understand their history. Sometimes people talk about saying buybacks were, in quotes, illegal before 1982. That's completely wrong. Buybacks have been around for a very long time. In fact, there was a series of really fascinating papers about buybacks in the 1960s. Charlie Ellis, by the way, one of the incredible luminaries in our industry, wrote a book about share buybacks in the early 1970s. But people don't seem to realize that they were around, and not only they were around, they were topics of books. The reason they were a little bit of the Wild West was you companies ran the risk of being charged with stock manipulation. And in fact, a lot of the discussion back in those days is, what percent of the volume is the company and so forth. And by the way, the SEC did bring cases against certain companies for stock price manipulation. So 1982, what happened specifically was the SEC set up a safe harbor provision that said, hey, companies, if you follow these rules, we're going to give you a safe harbor. You're not going to be charged with stock price manipulation. That is what opened the floodgates for companies to start doing buybacks in the early 1980s. I think you're an advocate of this. By the way, this is really important for people, investors, to think about this. Comparing dividend yields today to dividend yields in the 1950s or 60s is completely nonsensical. You should actually be using some sort of shareholder yield, which is net buybacks plus dividends divided by market capitalization. Much stronger signal, much more sensible, and a much more stable signal, by the way, as well. And there have been people advocating for dividends, in quotes, making a comeback. If buybacks get taxed further, maybe at some point there's a tipping point, but I just don't see any real reason. I think the flexibility that executives feel with buybacks is pretty substantial. And in fact, if they're doing it right and they have asymmetric information where they can buy low and sell high, but buy low for sure, if you're an ongoing shareholder, it's great. If the company really is buying stock for the right reason and you do nothing, you increase your percentage ownership in an undervalued asset. That's all good.
I know you're a big fan of Charles Darwin. So I actually pulled up about a half dozen Charles Darwin quotes that we're going to interlace through this podcast as jumping off points. I had one to start the show, but I got all excited about your new paper, so I got distracted. But there's some good ones. And then the one that I consistently think about is narrative and storytelling in our world. It's such a huge, huge force in thinking about dividend investing. So there's a Darwin quote where he said, "Often a cold shudder has run through me, and I've asked myself whether I may have not devoted myself to a fantasy." And so thinking about an idea that you look back on and say, oh, I should probably change my mind about this, or like I shouldn't adhere. But the problem in our world is where you have giant asset managers that are managing trillions that have been promoting a certain concept. It's a lot harder to change your mind.
On some level, especially if we get very theoretical, we can demonstrate the buybacks and dividends are effectively equivalent, right? You have to make assumptions about taxes and timing and all other stuff. But basically, it's a mechanism to return capital. And we all, if a company's buying back stock, you have the option to create a homemade dividend by selling your proportionate share and getting your cash and so forth, right? Okay, so that's all fine. The reality is that investors and executives think of them as totally different. So notwithstanding that theoretical equivalence. So for example, and this is maybe why there's a signaling thing, when executives issue a dividend and they want to raise it over time, and they think of it as tantamount to their CapEx and R&D and like sort of this is our priority way of spending. Then if they do all the investments they want and their balance sheet looks pretty good and there's some cash left over, then they go, oh, let's buy back stock, right? So it's almost like a residual thought. And I think that permeates a little bit of this whole discussion. The second thing is really interesting is our industry is replete with discussions about total shareholder returns. And just to state the obvious, total shareholder returns assume that you take your dividend and reinvest it back in the stock with no friction. So you could do that in a tax-free account, but the reality is, and this has been studied, Very few institutions and very few individuals actually do this. So the idea of total shareholder return is essentially a fantasy that basically nobody earns. By the way, mutual funds, they get a dividend check, they just goes into cash and they do whatever they're going to do with it. Individuals typically consume their dividends. They don't reinvest it. So that's another thing we just have to be mindful of is how do people think about, in quotes, when dividends come in, they're not reinvesting it in order to generate total shareholder returns. They're typically doing something different with it. So that's another thing just to mention. It's a very interesting literature on this. And it's almost like people don't recognize it. Oh, a dividend means, stock's at $100 and I get a $2 dividend. It means the day after it pays, I have a $98 stock and $2 in my pocket, right? They forget the fact that the price goes down by $2 to compensate for that dividend payout. So it's funny how you talk about storytelling, but people just don't think about that way at all. And you could see how that would be relevant for, mom and pop, and maybe if they're clipping dividends for whatever. But, institutions do the same thing, which is really interesting.
I think it's the mindset where people sort of confuse or they collate check in the mail. The dividend story is so ingrained, sitting on a beach, drinking pina coladas, and letting my dividend checks roll in. Like that sounds like an amazing fantasy to people, right? It's like you're getting paid to do nothing. And so that's interesting on the part of the consumption because the price-based return is quite a bit different than the dividends reinvested. Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.